What if I told you the global economy isn't built to be repaired, but to run on permanent debt? It's not temporary deficits, not short-term borrowing, but a self-reinforcing financial paradox. A system so deeply engineered, so quietly normalized, that most of the world doesn't even realize it's trapped inside. Here's the mystery. If every nation owes trillions, who designed the rules that make repaying it impossible? Why does every attempt to fix the system printing money, raising rates, bailing out banks, end up creating more debt than before? Why do the people who warn about it, the policymakers, the economists, the insiders, never actually change the structure? It's because the paradox isn't a glitch. It's the engine. A design that demands nations keep borrowing forever and punishes any country that tries to stop. Today we're going deep into the origins, the rise, the breaking points, and the fallout of a global mechanism built on debt. And why this silent system shapes modern history more than elections, wars, or natural resources. Stay with me, because once you understand how this machine works, you'll never look at money the same way again. Setting the stage, the origins of the paradox. To understand the paradox, we need to rewind not decades but centuries, because the idea that money must grow through debt wasn't born in the 20th century. Its roots stretch back to a time when kings funded wars through loans.
How long before central banks?
Long before global markets.
How?
In medieval Europe, powerful merchant families discovered a dangerous truth. Debt is more profitable than gold. Gold sits, but debt multiplies. And if you can lend to entire governments, not individuals, you earn something far more valuable than interest: influence. Fast forward to the 17th century, and something world-changing happened. England created the Bank of England in 1694. It wasn't a traditional bank. It was built for one purpose: to finance government debt. This model spread across the world: France, the Netherlands, eventually the United States, Japan, almost every major power. By the early 20th century, the pattern was set. Governments borrow, banks lend, currency expands, debt grows, the economy inflates. And the cycle never resets, because money itself now depends on debt to exist. The paradox was already forming, but the system had not yet reached its final form. That would require one dramatic moment. A moment that changed money forever. The rise when money became debt. The turning point, August 15, 1971. President Richard Nixon announces that the US dollar will no longer be backed by gold. It sounded like a technical policy shift. But it was actually the moment the world transitioned from value-backed money to debt-backed money. Here's why it mattered. Before 1971, money represented something real. Money represented what the government promised it would repay. A dollar became a piece of debt. A treasury bond became the world's most powerful financial instrument. And the only way to create more money was to create more debt. The paradox was now locked into place. The world must borrow to create the money it needs to function. From this moment forward, debt becomes essential. Inflation becomes permanent. Borrowing becomes unstoppable. Growth becomes mandatory, because without growth, the debt cannot be serviced. The global economy wasn't just linked to debt, it was now dependent on it. Paradox takes over cause and effect in motion. Once the gold standard disappeared, something strange happened. Every major economic solution began creating new problems that required more borrowing. 1. To stimulate economies, governments borrow, but the stimulus increases inflation. 2. To control inflation, central banks raise interest rates. But higher rates increase debt costs, forcing governments to borrow even more. 3. To avoid collapse, central banks lower rates again. But low rates cause bubbles that eventually burst, requiring bailouts funded by, you guessed it, more debt. The paradox becomes self-repairing. Every fix deepens the trap. Behind the scenes, something even more powerful emerges. Global debt becomes the world's anchor. Nations with high debt must keep interest rates manageable. Nations with low debt become pressured to borrow, so their currency stays competitive. Trade imbalances expand, currencies float, capital flows shift. But no matter what happens, debt goes up. Always, even in economic booms, especially in recessions, and catastrophically after crises. The paradox doesn't care if the economy is healthy or sick. It demands borrowing in both conditions. It is a machine with one output: more debt than before. The breaking point when the debt curve went vertical. There's a moment on the global debt charts where the line stops sloping upward gently and starts going almost straight up. That moment is 2008. The financial crisis wasn't just a banking collapse, it was a global test of the paradox. When the world's largest financial institutions were on the brink, leaders had only two options: let the system collapse under its own weight, or save it with historic amounts of debt. They chose option two. Central banks printed trillions. Governments borrowed trillions more. Interest rates were pushed to near zero, and debt globally exploded. It didn't climb slowly, it detonated. Within a decade, global debt increased by over $70 trillion. The world grew, but the debt grew far faster. The paradox now controlled everything. Nations couldn't stop borrowing. Central banks couldn't raise rates without triggering collapse. Economies couldn't stabilize without creating new bubbles. And citizens couldn't earn enough to keep up with the system's inflationary demands. The world crossed a threshold. The debt can no longer be repaid. It's only rolled over. Forever. The fallout. What happens when a system must keep borrowing today? We're living inside the consequences of the paradox. You see it everywhere, often without noticing it. 1. Housing costs rising faster than incomes, because the system rewards mortgage debt, not affordability. 2. Governments announcing trillion-dollar budgets without hesitation, because debt is now the lifeline, not the problem. 3. Entire generations priced out of asset ownership, because the system funnels cheap money into markets, not wages. 4. Countries trapped in debt cycles because growth never outruns borrowing. 5. Inflation becoming permanent, not temporary, because printing money is easier than reducing spending. The paradox isn't just economic. It reshapes societies. Voters expect stimulus. Politicians promise spending. Corporations rely on low rates. Citizens depend on credit. Markets panic if borrowing slows. It becomes impossible to escape. If governments reduce spending, economies contract. If they increase spending, debt rises. Either direction, the machine survives. Failed fixes. Why nothing has worked? Politicians and economists love promising solutions. But every major fix attempted in the last 50 years has failed, all for the same reason. They fight symptoms, not the design. Fix number 1, raise interest rates. Outcome: recession, higher debt payments, more borrowing to stabilize. Fix number 2, lower interest rates. Outcome: bubbles, overleverage, asset inflation. Fix number 3, austerity. Outcome: slowed growth, increased borrowing later. Fix number 4, stimulus. Outcome: immediate relief, long-term inflation, and more debt. Fix number 5, money printing. Outcome: currency devaluation, wealth concentration, permanent inflation. Fix number 6, tax-rich proposals. Outcome: minor revenue changes, debt keeps rising regardless. Fix number 7, balanced budget attempts. Outcome: political suicide, never sustained. No fix works because the paradox is structural. The global economy collapses without expanding debt. It's the cruel secret no government can admit publicly. Modern parallels, the terrifying data the world ignores. Here's where the paradox becomes undeniable. Look at these shocking global numbers. World debt, over $320 trillion, more than 3x global GDP. U.S. debt, increasing by $1 trillion every 3 months, not every year, every quarter. Japan, debt over 260% of GDP, yet still borrowing more. China, record corporate and local government debt driving growth through borrowing. Europe, negative real rates for years, meaning borrowing was effectively free. Average citizen debt, highest in recorded history. Mortgages, credit cards, student loans, every category soaring. Global interest payments rising faster than tax revenue, meaning nations now borrow to pay interest on previous borrowing. It's the paradox in numbers. The world cannot reduce its debt because the world is built on its debt. Even central banks, supposedly the stabilizers, now depend on it. Their balance sheets hold trillions in government debt. Reducing that debt crashes markets. Increasing it fuels inflation. The cycle cannot stop without triggering collapse, which is exactly why it continues. The pattern that always repeats across history. Every empire faces a similar pattern. Debt begins small. Debt becomes essential. Debt becomes unpayable. Debt becomes the system. Currency weakens. Inequality spikes. Social unrest rises. The financial system resets, or fragments. From Rome to the British Empire, to modern superpowers, the pattern is identical. Except today there's one difference. There is no new empire waiting in the wings to take over. The debt paradox is now global. Every major power is locked inside it. Every economy is tied to it. Every currency depends on it. There is nowhere to run. The three takeaways. 1. Debt is not an accident. It's the design. The global economy runs on borrowing the same way engines run on fuel. Stopping the borrowing stops the engine. 2. Crisis is built into the system. Booms and busts aren't unpredictable. They are the predictable consequences of a debt-based economic structure. 3. The future will involve a reset, not a repair. History shows no system built on exponential debt survives forever. The only unknown is how the reset unfolds. Inflationary erosion? Currency reforms? Digital money? Debt jubilees? A new monetary standard? Whatever shape it takes, it will be massive. The paradox will not fix itself. It cannot. It was never designed to. But understanding its seeing, the gears behind the illusion of stability, changes everything. You stop believing in the myths of temporary deficits, short-term fixes, or returning to normal. You understand why governments behave the way they do. Why inflation never disappears. Why the next crisis always comes faster than the last. Because the world isn't mismanaging debt. The world is designed to depend on it. Guess, if you found this breakdown eye-opening, there's more coming.
Oh.
Make sure you like, subscribe, and turn on notifications. Because we're diving deeper into the hidden mechanics of global finance, monetary history, and the systems that shape your life without your consent. This is just the beginning. Welcome to the truth behind the financial paradox.